Now that Cleanmore Appliance has determined their net income for the period on their income statement, they have that missing piece of information that they need to make their statement of retained earnings. And the statement of retained earnings is the same exact concept as the statement of owner's equity for a sole proprietorship. It's basically tracking the change in your corporation's value during the period. And what you do is you start with what your retained earnings were at the beginning of the period, add to it your addition, which is your income, and then subtract out your withdrawals, which for us is our dividends. The rule of thumb for corporations that pay dividends is when you declare them, you have to subtract them on your retained earnings. Not when you actually pay them, but when you declare them. So, what do we have here? Well, our beginning retained earnings goes into this column right here. And as we see on our worksheet, I'm going to hit equals and go back to the worksheet. We've got a retained earning balance of a big fat 0. We're going to add to that our net income for the quarter, which we have as well because we just finished our income statement. So if we go to the income statement, we see their net income was $1.8 million. In this line right here, this is our no-name subtotal. And we're also going to come up with $1.8 million, which means this company could have retained $1.8 million worth of earnings if it paid dividends, but it did not. How much did we declare in dividends for the period? Well, let's go find all of our declaration entries, and we only have one of them. And our declared dividends, as we see right here, were $390,000 for common and $18,750 for preferred. So if I go and I bring both of those numbers in to this sheet, and I want to figure out what our ending retained earnings is, well, it's what could have been our no-name subtotal minus what we paid out in dividends. So in total, we have retained $1,391,250 in retained earnings. You have a T account for retained earnings over here. And, oops, sorry, wrong one, there we go. And typically, what you would have to do to figure out your retained earnings T account is every time you closed an account, a revenue, an expense, etc., it would affect your retained earnings in the long run. The revenues increase the amount of money you could have retained, expenses decrease the amount of money, etc., which means you're required to do a whole bunch of closing entries. But in the long run, the increase to your retained earnings is always going to be equal to the income that you had for the period less what you withdrew to give to your owners. So as a cheat, just for this assignment, this isn't perfect practice, but it's going to save you having to do about 25 different steps. At this point, it's a good idea to go to your retained earnings T account and go and back to your statement of retained earnings, grab the net income, that what it could have been is $1.8 million, and bring it over to your T. And that happened on the 31st of March.